Okay. Well, thank you very much for having me. This is somewhat of a risky talk to talk about oil prices, so I'll give you the punchline. I don't know what they're going to do. But I'll tell you a whole bunch of things that you can think about how they might do something, and if you can put it all together, you can figure it out. But at least I'll give you an education this morning. I quit doing this for a living because, you know, it affected my hairline, and I said, why am I up here talking about this again? But anyway, I'm glad to be here. First thing I'd like to talk about is just some of the history, and on the top chart is going back to it looks like I can't read it for sure, but the 80s, the mid 80s. And it's just a tracking of what Brent spot prices are. And I didn't use WTI because WTI has had some issues with it because of storage and some of those other things. So it really hasn't been as good a marker, and Brent is more likely. But you can see the price goes flat. Around 1990, you had the Gulf War, and then you had a gradual rise, rose up to almost $150 and then crashed, then came back. We had about 5 years around 110, and now we have another adjustment. So that's the history. So it's volatile by nature. The next thing is you look and say, okay, what do the experts say? And I call an expert is someone who is willing to pay for something. And so we have this thing called the strip. And in last year in March, the prognosticators said that at this point in time, oil would be $100 a barrel. The green line shows what has actually happened, and now the current people who are buying have the red line, and they see that it's at the bottom and looks like it's going to go up. So these are the people who are supposed to know. My reaction would be I would be very cautious as to how much of this I actually believe. But there's some interesting things. First off, let's talk about the winners. And the winners are businesses that use a lot of oil and gas, and that's why you're seeing some of the inflation trends. We have oil and gas are used in making many products in this country, and as their price comes down, if they can pass along the savings, they don't try to, but if they have to, they will, that will help the consumer or the businesses. The consumer is a real winner. Sarah talked about. I've seen numbers that the average household across the country will save about $750 per household. So that's a huge savings. The oil importing countries like the U.S. See cheaper prices, so they're winners. The loser is the producing industry, and we're a little different here in Kern County because we are really more price sensitive to oil because of our tax base and our employment base and those sort of things. We're not like the rest of the country as a general rule. North Dakota is kind of like Kern County right now. So they're really feeling it. The other is the people who really hurt are OPEC. And I want to talk about that a little bit. Now, OPEC, that's a real wild card because they don't want to sit there and give their product away. It's that simple. They're not generous people by nature. They want to get as much as they can for the product. But what they've seen is, and this is why this is very different than past drops in oil production, or in oil price. They have chosen to act very early. In 1986 or in 1978, most of you probably aren't old enough to remember the gas lines and all those other kinds of things that we had. But Saudi Arabia tried to defend the oil price in the late 1970s. And they held the price at about $40 a barrel or $45 at that time. And they saw their production between 78 or 79 and 1986 drop from 10 million barrels a day to 2. And they finally in 1986 said, this isn't going to work. And they jacked the production up and the price crashed, and you saw the numbers up there from market. It was a big deal. So they have chosen to come in and get it right now and said we're going to do that. Now So that's in my mind a good thing. It's just is not going to forever. They're going to want to get more for their oil, but the fact of the matter is they're sending a message to the shale producers, to every other company, that, you know, Saudi Arabia is the big guy, and if they want lower oil prices, they're going to be lower. And if everybody wants to behave, they'll be better. So the collateral damage, you know, the energy industry suppliers are probably the first. The people who support the industry, the drilling rigs, all those kind of things, those are the fastest thing you can cut, and that affects jobs. And so the more rigs you had running, I've seen numbers, the rigs are down in the country probably around 40%. So that's a huge hit. But there's a whole other industry out there that's the maintenance and all those kind of things, and they're not going to change. They will continue to need people, need workover rigs, that sort of thing. But the energy industry suppliers are the ones who feel it first. The oil companies do, but they basically try to say, okay, my income's gone down, and then I want price concessions, I want this, I want that from you, and so on. So the guy who really feels it is the supplier. The governments with high reliance on energy taxes, Kern County. That's a $61 million hit to our county, and it's an immediate hole. Now, hopefully, there are reserves and that sort of thing to protect it, but that's a real loss. And the other thing is that expensive alternative energy is hit. I mean, it just means that it's not very competitive anyway. This makes it less competitive when you have cheap oil and gas, or relatively cheap oil and gas. So, okay, what I'm going to do here is just talk about what the, you know, if you have production in all these factors, what happens to the oil price as a result. So if you have rising production, supply starts to outstrip demand, oil production or oil prices go down, and that's what's happened. The U.S. has, because of the shale oil, has in 7 or 8 years produced another 3.5 million barrels a day. No one thought that was possible to happen, but it has. So that's a big question, and we know that caused Saudi Arabia and OPEC to make their move. However, the industry responds, and it cuts its drilling rigs. And when you cut drilling rigs, you cut supply, and that tends to force oil prices up. One of the key things that is different in this than in the past, and why you can't use the past necessarily as a predictor of the future, is these shale oil wells come on very, very quickly, very high production rates, but they decline very, very quickly. And so, you know, it takes a lot of activity to keep driving that production up. And if you stop drilling them, you're going to have higher production rate or decline rates than we've had in the past. Now, how does that play out? Well, we'll have to see. But it's very, very significant. And then there's less capital spending, like I said. And that affects lots of things, which I'll get into in a minute. Oil demand, we talked about the world economy. Sarah did a little bit. It's basically a basket case, but to the effect that it gets better and the world, you know, the oil price impact goes up. Interestingly, a stronger dollar has an effect in the U.S. of a decline in price, and that's a significant thing. It also, if you have, you know, it'll be interesting how the Fed does the interest rates, because here we have one of the strongest dollars we've had in a long time, and if you raise the interest rates again, you're going to have a stronger and stronger dollar, which then starts to hurt our exporting economy and so on. So it'll be an interesting balancing act to do that. But in terms of oil, a stronger dollar hurts the oil price. Okay, let's talk about oil and gas activity. And I really put them into kind of 3 brackets here. The majors, the majors are not as big a player in the short-term oil business as they have been in the past. they're more investing in long-term, deep water, huge mega projects, and they have more of a 20-year sort of a look about them. So they're not quite as sensitive to short-term swings. I call it, yeah, there'll be some moderation, but if you're going to play deep water, you're not playing a 2-year game. You're playing a 20-year game or a 25-year game. So in effect, but it won't be crazy. The independents are a different sort. I mean, they literally can start and stop on a dime, and that's what you're really seeing is the real areas that are, you know, stressed in the industry right now are the independents. They're not only because they're smaller, but a lot of independents, you know, they see 4 years of $100 oil and they say, man, happy days are here. Go out, man, I'm going to buy the world, get a bunch of debt, and it crashes. They can't cover their cash flow. So there's lots of things that happen with independents. So that's a big, big deal. International doesn't matter a lot because those are often contracts that are based on a margin. So if the price goes up, the country gets it. If the price goes down, the producer gets just what they get. So the swing is on the country. So that's not a big deal. That's different than the past. Interestingly, in the financial markets, if you look at that curve, that forward curve, it's called contango. It's in contango, and that means that people think the oil price in a year is going to be $8 or $10 higher than it is today. Well, that drives some very oddball behavior because you actually can produce the oil today, put it in a tank, sell it forward, and make 10 to 15% on your money. So, you know, it's a perverse sort of an incentive, but people do that. And so, you know, my thing, if that market continues like that, you're going to have every ship, every tank, everything that can hold oil is going to hold oil. Now that helps price right now because you're producing oil you probably would have to give away or sell for less. But if the day comes when you got to sell all that oil, it's all sitting out there and it comes and then the price heads back down. So it's crazy. Traders are another thing, and they're money people. They're not oil people, and what they're really interested in is money. And if they see things bad, they'll unload it, and a lot of them have done that. You know, 15-20% hit on their deal, but they said, I'm out, I've had enough. But that is going to cause a lot of volatility. The next thing is lower earnings. You can sit there and tell the market that, oh yeah, we're gonna have lower earnings and everything, and the market said, yep, that happens, and you know, we understand. Then you post the lower earnings, and everybody goes to pieces, and then so you'll have crazy stuff that happens. I mean, you know, everybody says, oh yeah, it's no problem, we understand, but they don't understand, and so we won't know what they do until they do it. So to come. And then wild cards, and this is where you can dream up anything you want to dream up in terms of what the effect is, and we've seen a lot of it. But what are the politics going to be? You know, it just you can do really stupid things, and you know, we're seeing a little bit of it on the fracking side. We've been fracking as an industry for 70 or 80 years without issue, but that is causing a lot of people heartburn because it's causing, you know, fossil fuels, even though they use them for everything. And so they say, well, you know, I just can't stand this cheap oil. And so you get funny things that happen. Regulation. We see it with the water injection. We've been doing it for years and years and years with no problem, but people look at it by the book, and oh, you weren't doing this, you've got to, you know, we've got to fix that, we've got to re-regulate, we've got to do this. So that has an effect. Transportation, which is, you know, really something. If you told me that we're going to be running oil around this country on trains, I would have said no. I had a funny story one time. We couldn't get all of our oil out by pipeline, so we had to rent one of these unit trains. This is a long time ago. And one of the pipeliner guys came up, and I said, boy, isn't that a thing of beauty? 100 cars all lined up with the oil going down to Los Angeles. It's wonderful. He said, you know what? He says, just cut the ends off of those and put them together, and now you've got transportation. So they want to make pipelines. So having this thing like Keystone, that creates a distortion in the market. And so who knows how long that goes. But typically, the safest, most environmentally conscious way of moving oil around and products around is by pipeline. And so we're doing it by train right now. Who knows? One of the other things, though, is you have accidents. And we all remember the accident in the Gulf of Mexico that shut down drilling for several years in the Gulf of Mexico. You're seeing these train car accidents and killing 50 people or whatever it was in Quebec, and spilling oil in rivers and all this. At some point the public looks at that and says, I'm not going to tolerate that. And so, if you had a reaction to that and you don't have an alternative, it's going to affect price. And then whatever else you might dream up, you can say. So, but they all could have major things. For instance, I told you about 1991 with the Gulf War, or 1990 with the Gulf War. If something like that were to happen and a big supply gets cut off, you will see an overnight jump. I don't think that's going to happen, but this is a crazy world and you just don't know. So let's talk about it. I'm a little bit cynical about this, having been in it for a long time. But the pundits and analysts will consider all of the factors that I just showed, some of them or none of them, and they'll make a forecast. And the worst thing is then they're going to try to convince you they're right and that you ought to invest your money on what they think. And that's what makes the world go round. It's lots of fun. The facts is nobody knows for sure what will happen, either in price or timing. The best estimate is probably what the market is saying it will pay for oil, and that suggests that over the next year it's going to gradually go up. But the past is not necessarily a predictor of the future, and I do think that the shale oil is a very different kind of oil than we've had in the past, and it has very different production characteristics. And that will play out, I think, pretty quickly the next 6 months or so. You'll really start to see what the impact of that is. We've added 3.5 million barrels a day that we didn't have. The forecasts that I saw are that there's another 1.5 million coming to a maximum of 5 and then gets pretty steady. We'll see whether that occurs. My belief is that that's probably high. So there'll be a pressure on that. We're not in steady state. We're in a very volatile state. So things are going to be moving up and down. And I just, if you need to get up and find out what the oil quote is in the morning, I'd probably take a pill or something and relax because I think a $5 or $10 move back and forth just isn't, over the long haul, just is not a big move. And then, of course, we will, as Mark said, you look back, or, Emerson said, we'll look back. We will understand it, how it worked this time, but it's after the fact. We'll have 20/20 hindsight. So what to do? Okay, if you're a consumer, you're going to save money. And I think it's a chance to take advantage of that. And Sarah said, looks like people are putting a lot of money into savings, and that's a good thing to do. You can invest, and if you actually, for the first time in a long time, there's actually an investment opportunity in the oil business, because you're not just playing technology and you're not just playing increased reserves. You actually have a price play potentially. So if you're sporting, you can do that. But I think the other thing is that the combination of cheaper energy prices and a cheap dollar, a strong dollar, if you want to go to Europe, now's the time to go to Europe. Take advantage of that. It doesn't cost you as much to get over there. It doesn't cost you as much to stay in a hotel. So if you're going to do it someday, this might be a good time to do it. And then my opinion is that oil prices will go up eventually. The marginal barrel just costs more to produce. That's all there is to it. And you saw that long-term run-up is going to continue. What we have here is a blip, a painful blip, albeit, but it's a blip. And now, will it go to $100 a barrel? Who knows? The market is saying 70, 75. In my day, we could make a pretty healthy living at $75 a barrel. So, okay, so what to do? And I've lived through this a number of times. The first thing to do is survive. And I say that not tongue-in-cheek. I really mean it. It's just, if you're not going to be there tomorrow, it's not worth it. So you've got to get your financial house in order. And this business has always been a business that has to have very little leverage in it. And so it really, people are going to have to, if they're over leveraged, they're going to have to deleverage. That's all there is to it. And it's interesting, I'm now a banker and I get to see the other side of it, but you know, if you come into me and say, you know, remember that oil curve out there in a year? I want you to loan on the basis of that. I'm going to look at them, are you crazy? You know, today it's $10 or $15 less, and at the best, I'm going to give you what you have today, and I'm going to protect against the downside. So it's, you know, it's going to be hard to go to banks and get money on the basis of what's the future in the oil business. So you need to have your very strong balance sheet. There's an opportunity. If somebody's really strong and you can get something at the right time, this is a good time to acquire. And so you will see people, as this goes along, you'll see people buy and sell oil companies. If you're weak, you have a choice, figure out how to survive, or you kind of be like those traders. You just say, you know, I've had enough. It was fun, and adios, I'm out of here. And I think this is an opportunity to really rethink how you fundamentally do your business. If you're not drilling as many wells and you have the same number of people, or you know, mostly the same number of people, you've got a huge chance to improve your productivity because you've got time to actually think about what you're doing. And I would tell people you have to be very, very careful in how you reduce staffing and how much staff you reduce. People do not like it when they get laid off. And not only do the people who get laid off don't like it, but the people who survive don't like it. And so you want to be very, very careful. And I think the industry's done a very bad job in the past by overreacting and blasting the people before they've really thought about it. And then when it comes back, they wonder why we can't hire anybody. So to me, yeah, you have to get rid of the obvious excess. But to me, I would try to redeploy those staff to improve my processes and reduce my costs. And it's amazing what people can do if they sit down and really think about their business, because the manufacturers have done that for many, many, many years, and they've continued to produce higher with less cost and less people, or you know, less cost. And you can, there's lots of places we can improve productivity in this industry, and we ought to take advantage of that. The other thing is there is a lot of new technology out there. How the fracking and horizontal wells were deployed in North Dakota and Texas and all those places to increase the nation's production by 3.5 million barrels a day in 7 or 8 years from zero tells you what you can do if you think about technology and do it properly. So, and then I always say that you should always be prepared for when the oil price returns, and it will, and you know, you'll make hay when it does. But you've got to fundamentally make sure that you're healthy enough that you're prepared. You just can't be in dead. And what I tell people, I have a kind of a joke. I tell them, I say, well, you know, in these times like this, you're like a patient, and you're in the ICU, and there's two doors. There's the morgue door, and there's the hospital. You're not in ICU thinking about where you're going on vacation. You need to think about, I need to get out of the ICU into the hospital. That's where we are today. We have to think of it that way. So finally, this is a Kern County perspective, because we do live here, and it is what affects us. And you want to hope for an oil price recovery, but you can't count on it. That's all there is to it. You can't count on it. It might stay with us. It could go lower. I doubt it. It won't. I don't think. But you better figure out how to live in this environment. And so I would say you want to be successful in the current price environment. That means you try to return your cost of capital. And what that does is that gives you some room in case the oil price were to come down more. So I think that's a real important thing. As crazy as it sounds, you just have to say, if it's 50 or 55 or whatever it is, I got to figure out how to prosper in that. And then be flexible enough to be able to take advantage of an upturn in oil price and don't sell the future to survive. So with that, I'd be happy to take a couple questions if we have time. Or I can sit down. Does anybody have a question?
Both mics should be on. Hello?
What's that?
Hello?
Yeah?
We have 2 mics, and we do have time for questions if anyone has. Please come up.
Yeah. How low can the price go and the independents still be profitable?
Well, okay, there's a common misconception a little bit. First off, it really costs very little relatively to produce a barrel of oil. So, you know, when people say we're going to shut wells in and all that kind of stuff, that's really not true. If a well goes offline, you may not go fix it, but you're not going to go out and pull the switch and say, I'm not making any money. So, you know, I've seen things on the shale oil that it's profitable at $40 to $45. But that will mean only the better part of the shale is profitable. So it really has to do with reinvestment. As at what point are people willing to reinvest? And I think that what happens right now is people have been burned enough in the past. They just say, my first reaction is I'm going to shut down. I'm not going to drill any new wells. And then as you say, gee, I can get my costs down, I can do this, I can do that, I think you'll see a gradual increase in it. But you'll have a substantial amount of activity around $50, even in today's market. And if it goes up a little bit and people kind of figure it out, it'll go back up. So, but you're not going to see people wholesale shutting wells down. That's just not going to happen. I hope that answered your question. Any other? Yes.
Is the North Dakota play as big as their prediction it is, and how many years, how long do you think it's going to play out?
Well, the numbers I've seen are that that in Texas, a lot of the other shale plays, it's a long-term deal, and it's 3.5 million right now. The numbers I've seen are sustained at 5 million. So, but that's going to take constant drilling, and you know they've almost have the, and the production still is going up a little bit, but it inevitably has to turn over if you're not replacing. And I think that's the $64 question: is when they have the number of drilling rigs, will the production keep going up or will it go down? My bet would be it's going to go down. And so, but oil shale is here to stay. I mean, it is truly a remarkable deal, and the costs have continued to go down. The production has continued to go up. So, anyway, I just got the signal that my time is up. So, thanks very much.